SpaceX begins trading. The war is over, or is it? I'm not quite sure. And some more on options theory today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. So first things first, obviously the SpaceX IPO was a very big deal. One of the largest, basically the largest IPO ever, $75 billion raise, $1.8 trillion valuation. Decent allocation to retail, and one of the questions I keep getting is when are the options going to start trading, and that is tomorrow. And the reason that they didn't start trading straight away is because options exchanges, there's a requirement that they have to have at least 2,000 individual shareholders, hit certain volume requirements and things like that. Now, clearly, SpaceX was everybody knew that it was going to meet all of these requirements to list options, but still there's a little bit of a process where that gets validated. So we should see SpaceX options start trading tomorrow. And that will be very interesting indeed because I expect a lot of activity. And one quick point I would also make is that in the past, the pattern that you usually see is that the volatility of a stock is higher in the early days, and then eventually it begins to find its footing. People begin to arrive at price, and as that happens, volatility will compress. So I would expect SpaceX to exhibit a similar characteristic. One important note is that, and I've mentioned this on more than one occasion, is that in the late 90s and into the early aughts, this was sort of another big time for equity markets as people were investing in the internet. So at that time, one of the things that did happen was that in some cases, as stocks were gapping to new highs, we did see volatility increase before it eventually came in. That was a little bit of a warning sign. I mean, SpaceX, it was interesting to me. I thought it was a very orderly IPO, and here we are, and we see that the stock is up another substantial amount today. It closed up $31.50, $192.46. So that's quite impressive strength. I think it's safe to say after Friday's already very, very strong performance. And the reason I bring this up is because when Facebook IPO'd many years ago, that was one of the larger IPOs of its time. So a $15 billion raise, $90 billion valuation. I'm going by memory, so if I have that off a little bit, forgive me. But that was a very large raise for its time, and it didn't perform particularly well on that day. Essentially, it traded very close to the IPO price, was supported by the syndicate bid, and the stock fell shortly thereafter. We're not seeing anything today or Friday that mirrors that performance. So very strong post-IPO trading performance from SpaceX. Okay, what is the other big news? And on my screen right now, I haven't shared this screen in a little while. Those who have watched will recognize what this is. We are looking at marine traffic, and we are specifically looking at marine traffic in and around the Strait of Hormuz. This up here that I'm circling in red, that is Hormuz. This is the Strait of Hormuz in here. And, generally in the area, in the time before the war, it was common to see 90 ships or so transit this strait on any given day. And then, of course, that traffic fell off precipitously after February 28th when the United States and Israel struck Iran. Now, what's interesting, of course, is that oil prices, while they certainly have gone sharply higher, and let's take a peek at that. So we'll look at Brent, I think, first. They have softened somewhat even before this deal was announced, as we can see here. One of the things that was mentioned recently was that supposedly the United States was helping to shepherd some oil transiting the strait during this period. that ships had their transponders off and were being escorted. I don't know if that's true. It, at the very least, it would help explain some of the price action that we have seen. Is it true? I don't know. I'm also not going to weigh in too heavily on what I think of the deal because from best I can tell, it seems like it's a deal to have more conversations about Iran's nuclear program. And my understanding was that that was the principal threat that we were trying to resolve. So has that been resolved? Best I can tell, it seems like an agreement to have more talks, and that doesn't really feel like a win to me. I will let other people who are more attuned to the situation weigh in on that. It also looked like we were freeing up about $25 billion worth of assets that the Iranians did not have access to. Giving them access to those things doesn't seem like much of a win either. Again, I'm going to allow other people to render their own verdict on whether that's a victory or not. But it is a victory as far as the oil markets are concerned. And if it's a victory as far as the oil markets are concerned, then it is also a victory for those that are heavily dependent. So for those that are familiar with the CNBC.com website, and if you go to cnbc.com/options-action, I write articles on that site and sometimes do short videos. One of the ones that I did was on the JETS ETF. So unsurprisingly, and I actually wrote the article yesterday. I don't know when it actually got published, maybe at the beginning of the day today. But my observation was simply this, and that is that one might expect that jets, so if you think about the biggest operating expenses for airlines, it's going to be fuel, jet fuel, and labor. And so as the jet fuel crisis subsides, hopefully, then we would expect that there would be some more upside. However, I would make the following point. One, this is the prior high, and that was the high even before the strikes on February 28th, and oil prices and jet fuel prices have been substantially higher on average since that time. So I was also noting that in addition to that, the jet's implied volatility still remained reasonably elevated. And because of that, it suggested, so I'm going to get rid of the historical here. So you can see it's still well above average. It fell intraday today, but it was over 40. And you could actually sell the 32 calls and the 27 puts and collect over $1 for July. And that created a buffer, an upside break even up around here and down here. So these first two lines are the strikes that I was suggesting selling, and the break evens were here and here by July expiration, which is the 17th. So that's going to be in this area here. So this looked like a pretty wide set of break evens to me, going out to July expiration to my eye. I just have a hard time imagining that it was going to break out to fresh all-time highs until there was a little bit more resolution, especially considering that it's probably going to contend with a little bit of upside supply at this area. And in any case, from a valuation perspective, barring something really catastrophic within the course of the next 4 weeks, this looks like a decent area of support and decent place to get long as well. Okay. So getting that out of the way, I wanted to continue the conversation that I started when I was talking about synthetics a week ago. And the idea here is that it is really important to understand a couple basic concepts. So we're talking about just selling options in this particular case, so I just have this rather quickly slapped together deck. I just wanted to make sure I touched on a couple critical ideas, and then we can go through some examples. So one of the important points that exists in finance is the idea of replication and pricing. So you'll remember that when I was talking last week about synthetics, one of the things I pointed out is that I can create stock synthetically using options. And I can create an option synthetically using other options and stock. So for example, long call, short put, same strike, same expiration is a synthetic equivalent to a long stock position. If you didn't see that video from last week. It's still on the channel, so you can go back and take a look. Long stock, long put is the same thing as a synthetic long call option. Again, you don't need to commit all this to memory. Long call, short stock is the equivalent of a long put option. So we can go through some of the examples for why this is true. But the important point to understand about all of this is that if I can replicate long stock using options, if I can replicate an option using a combination of stock and some other option or securities, or maybe I can replicate an option just by trading stock in some way, then we have a basis for understanding what all of these things are worth, at least in relationship to one another. Put differently, if I can synthetically recreate a security with some combination of other securities or assets, then the price of that security cannot be grossly divorced from the price of the other things that I can use to synthetically recreate it. Because in an arbitrage-free world, what will happen is traders will buy the underpriced asset and sell the overpriced one until such time as these prices converge to one another, or at least to the degree that they converge sufficient that it's going to cost more to affect the trades than it's worth to try to squeeze out the last bit of edge, right? So when it comes to options, one of the things that is important to understand is that we know that the value of, say, a call option. What is a call option? A call option gives you the right to buy the underlying stock. In the case of an American option, sometime between now and an expiration date, European option on the expiration date, it gives you the right to buy the underlying stock at the strike price. All right? Now, it should stand to reason a couple things, even just at a high level, if you're trying to understand what that's worth. The closer the stock price is to the strike, or the higher the stock price is relative to the strike, the more the call option would be worth. So if I have a $100 strike price and the stock is 10 and it expires in 1 week, that call option is not likely going to be worth a great deal. If the stock is 80, that call option would be worth more. And if the underlying stock is 100, so it's right at the money, then it's going to be worth more still. And if it's in the money, of course, it'll be worth more. Now, what else is going to affect the value of that option? How much time I have to go to expiration. So, again, if I have a 100 strike call and the underlying stock is 10 and the option expires in 1 week, little or no chance. But what if it expired in 10 years? Now, that's a slightly different scenario because while $100 is well away from 10, over the course of 10 years, can a stock move that much? It can. NVIDIA moved in a magnitude like that. Broadcom moved of a magnitude like that. AMD moved a magnitude like that. Tesla did. Many stocks have. Most didn't, but many did. So then it has more value, of course, right? So the amount of time that you have has an important impact. And of course, how volatile the underlying stock is going to have an impact. If you are dealing with a utility, or if you're dealing with Procter & Gamble, you're dealing with Kimberly-Clark, you're dealing with a stock that doesn't move very much, then that far out of the money option is much less likely to get into the money than a highly volatile stock would be. So what do we know now? We know that the things that are going to matter in the value of an option is the price of the underlying stock's proximity to the strike of the option, how much time there is, how volatile the stock is. All of those things are going to play into it. Now, options theory at its core recognizes these critical elements. How much time there is, the price of the stock, how volatile the stock is, the strike, and so on. And the critical thing when they were originally trying to figure out how to price options was, well, if we understand these relationships, would it be possible to replicate the value of an option only trading the stock. If you have a long time to go and the stock is volatile, the option's not going to behave just like the stock. It'll behave somewhat like the stock. So some percentage of the stock will represent instantaneously how we think that option will behave. A certain amount of long stock will replicate the performance of a call option, and a certain amount of short stock will replicate the performance of a put option. And this replication principle is the foundation upon which options values are created. That is essentially the whole, that's the backdrop of Fisher Black and Myron Scholl's work, and subsequently Robert Merton. So when we think about the Black-Scholes model, that's essentially the idea, that they were trying to conceptually say, we know that options behave a little bit like stock, and it's going to depend on a couple of these different factors, and maybe we can come up with, in the case of the Black-Scholes formula, a closed form solution. That means a formula which will describe how much an option is worth because I can replicate it simply by trading the stock. And that's what options traders do. Options traders look at the behavior of the stock, and then they come up with these basically inputs into the model. And then they replicate it. And in fact, if they buy a call option, they hedge it by replicating the inverse. So if you sell a call option to a market maker who is agnostic to the price of the underlying stock, which is what we were originally taught to be, they will actually replicate a short call option and essentially try to arbitrage the difference. So that's actually what's going on. When a market at a high level, if only one option was trading, a market maker either buys the option or from you or sells the option to you, and what they do to hedge is they replicate it with the stock. And so they're going to trade a certain amount of stock against it. If they buy the call, they'll sell some stock against it. And then as time passes, because we know that that impacts the value of an option, as the volatility rises and falls, that will adjust how much of the stock they need to buy or sell. And as the stock price relative to the strike price changes, they will adjust that. And that is called delta hedging. And their objective in this is to try to replicate as closely as they can the behavior of the call option itself. And so what this means is this replication has an important element for how we understand the value of an option. All right? Now, there's some other things that I want to really drive home. I think this is really important, is understanding that there are arbitrage constraints that exist. And I've spoken to very smart people who sometimes seem to miss this, or they miss elements of it. And if you're going to trade options at all, you got to get this part at least. So let's just talk about a couple of things that must always be true. And if you recognize this, it's a good start. You do not need to understand options theory completely. You do not need to derive the Black-Scholes formula or its subsequent variations, Black-Scholes-Merton models, Cox-Frost models, and so on. You don't need to do all of that to figure out how to trade options profitably. But you do need to understand a couple things just to make sure that you don't accidentally give money out to the street for nothing, right? So what are some of these things that we want to make sure we really understand fundamentally? So here's a couple things to think about. A call strike, and the inverse of this is going to be true for puts, but a lower strike call of the same expiration will always be worth at least as much and often more than a higher strike call. This should make intuitive sense, but I'm going to just make sure that I drive this home because I sometimes see people trade as if they didn't recognize how important this is. A lower strike call option, the right to buy an asset at a lower price, will always be worth at least as much or more as the right to buy the same underlying asset over the same period of time at a higher price, right? That it should be intuitive, but I just want to make sure that that's sort of built into your framework. And the reason it's important to remember this is because when you trade options and let's say you sell a call spread, all else equal, the long call, so when you sell a call spread, you sell a lower strike call and buy a higher strike one, presumably as some form of a hedge. All else equal, the lower that high strike is for the same amount of money, the better off you are. Always. This is non-negotiable. With a put, same expiration. The higher strike put, the right to sell an asset for a higher price is always better than the right to sell that same asset for a lower price over the same period of time. Makes perfect sense. There would be no circumstance where the right to sell it for a lower price would be better than the right to sell it for a higher one. We should know this implicitly, but when we look at options, it's really critical. Some other arbitrage constraints, and this one is kind of important, and we can go over some examples. But a call spread or a put spread must always be worth an amount equal to or less than the distance between the strikes. So we now have two sort of important things. A lower strike call is always worth an equal amount or more to a higher strike one. And the distance between the strikes defines the most that spread can be worth. A $5 call spread is never worth more than $5. It could be worth $0. It could be worth $1. It could be worth $2.50. It could be worth $4.95. But it can never be worth $5.05. All right? So that is an arbitrage condition. If you ever have the opportunity to sell a $5 spread for $5.05, avail yourself of it. And you will lock in at least a nickel, and maybe more, depending. So that is an important element. And in fact, that very test is used by many financial institutions to validate the theories that people are using in volatility space to price options more generally. Because what they can do is they can look at all options. They can say, a trader can use whatever volatility assumption you like. Just put in any numbers into the model you want. The people who are validating what the traders are doing can always test it by observing some fundamental no arbitrage violation taking place. So a trader could say, I think the volatility is 30, or they could say they think it's 300, or they could think it's 10. What the bank needs to do to make sure that the trader isn't playing some funky game is just to make sure that if you use the trader's assumptions, knowing nothing else, does it violate an arbitrage condition? If it does, you know something's wrong. Okay. Put call parity. That's this bottom one. Now this is what we were talking about last week when we talked about synthetics. So buying the call, selling the put, and looking at the financing cost, which is either the dividends I'm foregoing or the interest I am collecting by maintaining the cash in lieu of actually purchasing the stock, that these things don't create some kind of an arbitrage condition as well, right? So very, very important stuff here. And I'm assuming that most of you know this, but I'm bringing it up because on a couple occasions recently, it has become clear to me that even people that I think should have this really well in hand sometimes don't. And, I worked for a company that was developing actually an AI system to help people trade options. And the quants, who were very smart people, they had things in the system that didn't guarantee an arbitrage-free condition. And that was because they assumed that certain ludicrous things could happen, that skews and so on would get wildly out of whack, not recognizing that we have to live in an arbitrage-free world if we're going to price options. Otherwise, any mechanism for pricing them essentially goes out the window. So we have to have certain fundamental rules that we live by when we price these things, or else we've got a real problem. So that's why I bring this up. So if you want, you can, sort of screen grab this or just remember that it's important. Again, it's not really critical to trade options successfully to know how volatility traders trade them, but it is important to understand that there are certain requirements we have for arbitrage-free conditions that have to go into the calculus for all of this. So here's something else I want people to think about, and this goes into the whole notion of trading spreads to begin with. And this is the notion of conditional probabilities. And because if we go back to my earlier trade, my Jets trade, right? So where I said sell a strangle. Let me go back to that really quickly. Where's my short strangle? Where did I put that? Is that here? Here we are. Okay. So let's think about this for a second. If I say, what screen? Whoops. Okay, something happened. It seems that my screen share froze, so let me see if I can correct that very quickly. All right, hopefully, producers, please verify that this is true. Okay, so what you should be seeing is Jets again, which is where we started. Now let's start with my original premise. And the original premise was that jet fuel prices will steadily normalize. As they normalize, that's good for the airlines because jet fuel is one of the two largest operating expenses for an airline. And I say one of the two largest because whether it is the largest or isn't depends a little bit on where fuel costs are. So when fuel prices are astronomical, if crude's at $150 a barrel, then fuel costs might actually surpass labor costs in theory for an airline. So there, one of these things is going to be moving around a lot. But here we have the premise. The premise is fuel costs are going to normalize. That's bullish. There's overhead supply. That's not bearish, but it does create some kind of a cap there. We are a little bit uncertain about whether the deal that's been made in Iran is perfect. Certainly it probably isn't. But what that means is that we think that jets could be range-bound. All right. So we think it's range-bound. We think that implied volatility is high, so we sell a strangle. We sell an upside call, a price at which we'd be willing to get short jets, and we sell a downside put, a price at which we'd be willing to buy it, in exchange for which we collect the premium. And we can see that the break-evens here are reasonably attractive. Why would we ever want to sell a call spread instead of just selling that call? Think about it this way, right? So if I am going to be willing to sell jets at $32 and I'm willing to be paid to take that risk, why would I ever buy a call that's even higher? I've already sort of drawn my line in the sand, if you will. I've already told you that I don't believe it's going to go above that level over the course of the next 3 or 4 weeks. Well, the reason that I might be willing to do that is not because I think it's probable that it would go through, because if I thought it was probable, I'd never have sold the 32 call to begin with. I'm not even saying really so much it's because I think it's possible, although I'm acknowledging that. It actually is for a different reason, and that is that I know I'm not perfect, I know I make mistakes, and I know I could be wrong. I am asking myself a fundamentally different question. It's a conditional probability question that I'm asking myself. What I'm saying is, well, if I'm wrong, because I can be, and often am, what then am I dealing with? I'm dealing with something called a conditional probability, right? A conditional probability is contemplating the world when I'm wrong. What is the value of the call option, that higher strike call option, in that time and place? And what's interesting is that you can, if you do an analysis, and actually I'm going to stop this for just a moment, but what I'm going to do here is I'm going to do something, we're going to look at a histogram of returns, okay? So what I am saying when I'm willing to sell that call is that if you look at this distribution in here, is that these events happen with less frequency than the options market is suggesting. And I'm trying to capitalize on that difference, right? So if this normal distribution, and I recognize that options prices don't necessarily imply that prices are completely normal, but if we look at this bell curve here in orange, this shape right here, what you can see is that there are a lot of gaps. That is, that in here, these events appear to happen with less frequency than a normal distribution would suggest. And I'm trying to capitalize on that by selling an upside call. So the price action suggests that I should make money if I do that. The reason I'm buying that upside call is because I'm acknowledging another reality. And the other reality is twofold. One, if I'm wrong, how wrong might I be? And if you look over here, one of the things you're going to see is that, yes, it's most likely going to work out. But it also illustrates that when you're wrong, sometimes you can be very wrong indeed. That you have these moves going on up here that are way bigger and more pronounced than a normal distribution would suggest. So essentially what you're doing is you're saying, I know that this is a trade that's going to make money most of the time, but I'm also acknowledging that in those instances when it does not work out, you can have these really exogenous and idiosyncratic events. Now, in this particular case, we're looking at JETS. JETS is an ETF. It's not one stock, it's several. So this isn't an earnings event. This isn't a takeover that is taking place. It's not that situation. Let's say that they had actually allowed JetBlue and Spirit to merge and Spirit Airlines had been acquired by JetBlue. That's not what this is. This is just acknowledging the fact that from time to time, you have these really big moves in stocks. Sometimes you have really big moves in groups of stocks. And selling that call might be strategically hedged by buying a further out-of-the-money call option to hedge it. And because you can see that it does happen from time to time, you want that call option to be one that is going to have some value. You could sit there and say, I'll buy the highest possible call strike I could ever find, and I can pay a penny for that. But that's going to be way out there someplace and will never actually end up playing. And because of that arbitrage condition I previously described, where a lower strike call, all else equal, is always more valuable than a higher strike one for the same money, then what you want to do is get the when you're selling call spreads, you want to get the lowest possible strike that you can for that long call, all else equal. So let's just take a look at an example out in July and see what I'm talking about. So we'll go out to July here because that's the expiration I was looking at. And if we go, let's see, I wonder how high these strikes actually run. Let's see. Are there only 22 strikes? Maybe. This might not even prove to be the best possible example, but here's an example. Yeah, let's just take a look at this, right? So why am I bringing this up? So if we look here, you're going to notice that, and this is why you want to pay attention to these things. If you're looking at the 36 strike calls, you're going to see that these calls are no bid at 34 cents. And you're going to see the next ones down are 15 at 39. And the next ones down are 16 at 65. So far, so good. But the question one might ask is, let's assume for the sake of argument that the best price that you could ever hope to get any of these options is 20 cents. Right? That you could not find a willing seller for any of these at a price lower than 20 cents. Well, all else equal, if that's true, you would always be best buying the 34s at 20 cents, right? Than buying the 36s at 20 cents. For exactly the reason we described, because it's an arbitrage. If you can own the 34s at 20 and sell the 36s at 20, So let's just assume they were all trading at the same price. Not going to happen in the real world, or it shouldn't. That would be found money. Sometimes, most of the time, you wouldn't make any money in that trade. And what's the most that call spread can be worth? We talked about that also, right? The most it can be worth is the distance between the strikes. So a 34-36 call spread will always be worth somewhere between 0 and 2. And because it cannot be worth less than 0, the 34 will always be worth more than the 36s. So the objective here when you're selling call spreads then is to buy an upside call at some price where it might potentially have value if and when you need it. If and when the underlying violates that strike that we are reasonably confident it's not going to go above. That's why we're selling the 32s to begin with. So you're really just trying to hedge this situation over here. So I hope that helps out a little bit. Now, I'm going to bring up the question section just in case we have any. Someone says, hello, everyone. I was happy to get assigned some SPCX. You got some SpaceX at the IPO price. So in options land, when we say you're assigned, that means you were short an option, and the counterparty exercised your option, and you were therefore assigned. But you did get an allocation. You got a piece of the IPO. Congratulations to you, Dennis. That is very exciting because that means you are already up some money. And that's, it's interesting. I was asked, somebody asked me internally, oh, did you get any? I didn't even realize we could put in for it because I assumed that we probably could not. Never bothered to check with compliance. I know our head trader actually did, and I only found that out after the fact. And he didn't know whether he got allocated any shares. I think he put in for some through Schwab, if I'm not mistaken. I can double check that. But I believe that Scott Snyder, who's probably the most senior trader day to day, that he had put in for some. I don't know if he got any. And I was on the phone with him earlier today. I should have asked a question. It's an obvious one, right? But congratulations to you, Dennis. That's quite exciting. So FinWest, good morning. I was wondering about the SpaceX options. Good to know it's soon. Yeah, I mean, I expect that thing to trade in some size. There's going to be a lot of volume, would be my expectation. So Joe Kamen, happy Monday. I failed to trim my portfolio during the last 45 days. Given today's 3% jump in NASDAQ, is now a good point to trim my tech stocks. Need cash for Anthropic. Oh, boy. Well, if you're taking money out of the NASDAQ, which is tech heavy, I'll admit it, to pile into Anthropic, you're not really trimming your tech position, I think it's safe to say. I would argue you are doing what we might call a Texas hedge, kind of doubling down. But I think that this is as good a time as any to potentially take a little bit of profits, free up some cash? Sure, why not? I mean, certainly it is better than some other opportunities that folks may have had to do that. So I don't know how you have exposure to it, but here we are. We're essentially almost right back to all-time highs. So another way that people could do something if you wanted to was you can hedge. As I've previously articulated, I think that put spreads can be a good way to do that, because the skew ends up meaning that you can get reasonably attractive risk-reward relationships for long put spreads. And let's just take a look at the NDX skews here. So I'm just going to get rid of this. I'm going to get rid of that. And we're not going to look at the 3-month options because I don't really think that's... Most people are probably getting out closer to something in this neighborhood, something like a 1-month. It's quite flat on the upside. Look at that. So maybe you might look at getting like a 30 delta 1-month downside put option and hedge it, and let's see what that would look like. If you're looking at NDX options, which is good a place to look as any, but we can look to the Qs in just a second. So we were looking at July regular way expiration. Let's just go out to that anyhow. So the 30 delta puts, those are going to be, what is going on here? Okay, here we go. So that's going to be in and around the 29.6, 29.575 level if you're looking at NDX. So that's about a 24, what we got here? So okay, yep. So that's about 24 vol. You're looking at about $440 a contract, $44,000 a contract, give or take, using the 100 multiplier. And, you know, if you're looking to get a nice, say, 3-to-1 plus or 4-to-1 payoff, and actually, you know what I'm going to do, because I recognize that that's a little chunky for some. You can use SPX options, which aren't, those contracts aren't quite as big, but you also, why don't we just pull up options play real quick here. We can just look to the Qs for an example. We'll do that. This is another way you can reduce your exposure without actually selling anything. Because this will just mute your downside exposure in the event that tech or the NASDAQ or whatever rolls over. So I'm just going to toggle that over to bearish. We'll go out to July. Go to July month end if you chose. I was looking at, you know, something like a 30 delta put. I tend to default to this for a couple of reasons. One of them was Goldman Sachs did some work a while back where they did an analysis of, you know, bang for your buck hedges. And, you know, the work that they published at the time was, you know, 30 delta, 30 days, you know, a good trade-off risk-reward relationship. So one of the other things I like to see is that if you're going to trade a spread, that you're getting a somewhat meaningful offset for the premium you spent. You know, maybe 30%, 25 to 30% of what you're spending. So that's going to work out to, yeah, this one right here that it just defaulted to. This is a $50 spread, and, you know, mid-market, you're getting about 32% of the premium spent on the higher strike put for the lower strike one. The Qs close at 744, so this gives you protection down 10%, which is a nice convenient area because that's formal correction territory, formerly a pullback of 10%. And we're not quite to the prior highs, but we're pretty close, so it's about a 10% drawdown. And the other thing we like to look at is the risk-reward relationship. How much do you make in the event that you go to that lower strike relative to how much you spent to buy the spread in the first place? This is a $50 spread. It's going to cost you $7.60. So that's going to be 50, 760. So you make $42.50, just about, versus the $7.60. That's a payoff of almost 5.6 to 1. So that's another way that you could potentially look to, you know, reduce your exposure to tech. Of course, that doesn't necessarily free up capital unless you're going to use margin, but it would mute the downside risk somewhat. All right. Heart Fixer 100, but of course there are already SPCX, SpaceX levered ETFs. Yeah, you can buy levered ETFs. There will be a lot more available once options start trading as far as ETFs are concerned. As far as we're concerned, I can't discuss anything that's not out there, but I can say we had a filing back on April 28th, and people are welcome to go and take a look and see and read our filing. Such is the nature of the regulated industries in which we live that we are very frequently only allowed to discuss what we've already disclosed, which isn't really all that helpful, I guess, but it is what it is. I expect there will be a lot more products. First of all, there's going to be a lot more products that are going to include it. There are going to be some indexed products that include it because of its inclusion in some indices, not all of them. Like the S&P, for example, is not bending the rules, so to speak, which I think is fine. But there are other indices that will include SpaceX as a constituent. And as some of these other stocks come out very soon, they too are going to be included. And so they will be part of actively managed ETFs. They are going to be a part of several indices. There will be options trading on them. So there's going to be a lot to do, I think, across the space. And it's going to be very interesting. Continue to watch it for sure. Okay. Let's get back now, if I may, to what I was talking about before. So I was talking about this conditional probability, the reason we trade spreads. And you can see, so I just came up with an example of, why we use spreads when we are buying a debit spread and why we use spreads when we are selling a credit spread. So we buy the higher strike call option when we sell a call spread to deal with these conditional probabilities, the events that were not part of what we are betting on, but that do sometimes take place. And what is the value in that instance? The other thing that we look to in the event of that put spread is sometimes you can pretty materially reduce the cost. In that case, it was more than 30% we reduced the cost of buying it because that's going to reduce our exposure to decreases in implied volatility. It mutes the amount of decay we're going to pay. And you can still end up with a very attractive risk-reward relationship, 7.6 to 1, 5.6 to 1, payoff in that instance. That's quite good. So just going over this one more time, you are not, when you sell a credit spread, and we actually trade a lot of call credit spreads. And when I say we're probably amongst the most active in this space. Why don't we just sell covered calls? It's because precisely those times when you really didn't think you needed to sell that, to buy that upside call is when it proves to be the case. We had some instances last year, AMD, NVIDIA would be examples where we sold call spreads against long equity positions. And had we simply sold covered calls or just sold the calls naked outright, we would have sacrificed a lot. And we were able to keep pace with the performance of the underlying equity over the course of time because we had short call spreads instead of just short calls. So it really is quite important. Let me see if I can come up with an example. In fact, I know I can come up with an example, and I might as well just share it. The one that I usually do is AMD. Oh, I stopped. I keep hitting the wrong stop button, so I'm not getting rid of this deck. What I'm instead doing is canceling my screen share, which is not what I want to do. So what I'm trying to do is the following. All right, let's do this. All right. So I have AMD up here. It had a really sharp, I don't know if you can see this, and you probably can, but right in here, early October of last year, post earnings, and you can see that it really made a move right in this area right here, right? So this is basically early October. So I'm going to put this in. Big move in AMD, 58%. Now, we were short call spreads in AMD at this time. And if you had been short calls instead, it would have had a very different outcome. Very different outcome. Okay? And the reason is because you would have capped your upside right in and around this rally. So one of the things you're going to see here is that our total returns over just the month of October, 46.17, paying distributions and being short options premium to the upside, we captured roughly 80% of the total move. But that was only possible because we had traded a call spread, because you had this really sharp move. Prices were not really continuous at that time, right? So we call those price jumps. And the price jumps are when you get this kind of a thing. So now I'm looking at AMD. So in general, you don't mind selling these calls, right? Because you can see that there's this kind of stuff going on, that the calls sometimes are overpricing potentially what happens in here. But then you have to account for that. That's the whole purpose of these call spreads. Okay. Hi, Mike. When you have time, can you discuss long and short box spreads? Short for as a loan alternative and long as a yield substitute. Sure. So when you trade a box, you're essentially trading a zero coupon bond. And what is a box? Well, I'm going to, I think in options play, I cannot put in index in there because that's typically where this would go. Can I put it into, I don't know, can I, I'm going to ask the producer. Okay. All right, so there's no index information in there. I'm going to construct it. Construct a box. And then explain very quickly that in general, when you trade boxes, for either lending or borrowing purposes, you don't typically do it in an ETF. All right, you would normally do this in a cash-settled index option. So, and they have a couple things. Because they're cash-settled, because they're European, that's the pure play. So, what I'm about to illustrate is an example of how a box is constructed, but it is not using the product that you would use to do it, because what you would use would be something like NDX options or SPX options, right? So when I traded boxes, which I used to do quite a lot of, I would typically trade SPX. And just so you know, in general, I only traded them one way. I was always a seller of boxes, and it just had to do with the way I was charged for capital when I was on the sell side, when I was at a bank, right? So our marginal cost of capital to post, even on risk-free or relatively risk-free positions, was fairly high relative to the market. So it was better to do it for me on SPX. But I'm going to construct a box using SPY because, unfortunately, I can't use an index in this application. But I can illustrate what that would look like. So what is a box? A box is when you take two combos of different strikes and you buy one and sell the other. If I buy the lower strike combo and sell the higher strike one, I am buying the box. And if I do the inverse, I am selling it. So let's do this. I'm going to go out 1 month. We'll just go to July regular. And I'm going to do something, and it's going to seem silly at first, but there's a reason. Okay. So SPY, is about 750. So why don't we go down and we'll just choose something that's well and truly deep in the money. So we'll use the 500 strike. So I'm going to buy a 500 strike call. I'm going to sell a 500 strike put. All right. There we go. And then I am going to sell a much higher strike call. Go all the way up to 1,000. Should I go up to 1,000? That's probably, if I was doing this in SPX, that would work well, but we'll choose something a little tighter. What the heck? We'll choose the 800s. We'll make it a 300-point box. I will sell the 800 strike call, and I'm going to buy the 800 strike put. And you're going to see what we get here. So I bought the 800 put, sold the 800 call, sold the 500 put, and bought the 500 call. So that is saying unknown strategy. Unknown strategy. Why doesn't it know what a box is? So remember what I was talking about before, and that is that if I buy a call and sell a put of the same strike and expiration, that's a combo, that's a synthetic long. And of course, if I sell a call and buy a put of the same expiration and same strike, that's a synthetic short. So in this case, I'm going to have an outlay that is very close to the distance between the strikes, which is $300 times 100, $30,000. Now, if I was doing this in SPX land, what I am doing is when I buy the box, I am loaning money to the person who sold it to me, right? Because I am spending premium, they are collecting it. I don't have any directional exposure to the underlying. And I don't have any directional exposure to the underlying because I have a synthetic long in the underlying, the lower strike combo, and I have a synthetic short in the underlying, the higher strike combo. So directionally, I'm not making a bet one way or the other, right? All I'm doing is I'm spending premium in the hope that I'm going to get more premium back when the whole thing is said and done. And one way you can do that is that if I trade a box, in this case, this isn't the world's best example because due to the price spreads, you can see this is over 30,000. So we can actually check one other thing, and this is going to actually play into this. And that is that if I'm doing it on an instrument that actually pays a dividend, I can also trade that aspect. So it is not uncommon upstairs, when I'm talking about on the desk, for people to trade dividend swaps, to do reversals and conversions where you're trying to arb out minor differences in the dividend. But this goes ex-dividend on the 18th. And the anticipated dividend amount is $186 a share, as we can see. And if I own the in-the-money call options, I can exercise my call options and capture the dividend, right? Whereas the out-of-the-money call options, no one's going to exercise those early because they're out of the money, right? So it would not make any sense to exercise those calls early. So by trading this box, I also have the opportunity to collect the dividend because I own the lower, by virtue of owning the lower strike combo, whereas I've sold the higher strike one, which is not going to end up playing in the dividend. So the dividend ends up going into this. It's one of the reasons why when you look at SPX, it's a little bit cleaner because since you can't exercise the options early and there is no real dividend because you don't own the underlying stock. In any case, it's going to end up trading much more like sort of the fixed income instrument you're trying to replicate. But effectively what happens is when you do these trades, you are lending money to the people who want to borrow it at essentially what's going to be very close to the risk-free rate. So in SPX land or NDX land, if you were doing this, you would similarly trade a box, buy a deep combo, sell an out-of-the-money deep combo to the high strike. So the call's deep in the money that you're buying, the put's deep in the money. And if you're trading it that way, you are lending money. And if you're doing it the other way, you are borrowing money. And typically what will happen is that these boxes will trade at a discount to the distance between the strikes. So effectively, and then they settle to cash, right? So if it's a 1,000-point box, I would expect to pay a discount that is in line with about the risk-free rate, right? With the expectation that on settlement, I'm going to receive cash that is the exact distance between the strikes. So if it's a 1,000-point box, I will receive $1,000 on settlement. But when I initiate the trade, I'm going to pay some amount less than that. $990 maybe. So essentially, I'm going to collect $10 worth of interest over the period of time between now and the expiration date. And that amount of interest is going to be roughly approximate to the risk-free rate. The market's going to be made something around that. And this is really critical for people who have really big options positions where you get net long a lot of premium because you have to post that premium. So short a couple boxes, get your premium back to even. You're going to pay a little bit of interest, but the amount of interest you pay is not going to be ludicrously high. And you take down the amount of premium you have to post against your positions, which is not so relevant, I think, for people who don't have margin positions associated with options, but for those that do, this can become quite important. So I hope that's helpful. And I really wish I could have illustrated this a little bit more cleanly, but neither of those two applications. I guess I could build something into a spreadsheet. Maybe I'll do that next time, because I've just chewed up an hour of your time. So let's do that. Wednesday, I will come up with a way to better illustrate what a box is, but I'm going to explain it one more time in the meantime. If you are buying the box, you are lending money. You are buying the deep call, so you're buying a lower strike call. You're trading a combo on the low side where you're buying the low strike call, selling the low strike put, and then you're buying the high strike put and selling the low strike call. That is the buyer of the box. You are the lender, and you would expect to spend, if you're trading SPX or NDX, less than the distance between the strikes. Because remember, with those vertical spreads, they can only be worth the difference between the strikes. So a 1,000-point box, most could be worth is $1,000. So if I'm lending, I am expecting to spend less than that amount. And the difference is the interest I'm going to be receiving. If I'm the seller of the box, I am the borrower. I'm going to expect to receive less than the distance between the strikes. And the difference, which is what I have to pay at the end, because I have to pay the difference between the strikes at the end of it, that's the interest I am paying to borrow the money in the interim. So if it's a really short-term box and I sell it at $9.90 with the expectation of having to settle at $1,000, that means I'm going to pay $10 in interest on a $1,000 loan, or 1%. And the exact opposite for the person who is buying the box. Spending $990, expect to get $1,000. I'm going to collect $10 on a $1,000 bet, or just about. So I'm going to collect a little over 1%. So I hope that makes some sense. And it's much more common to trade these on the institutional side, because usually retail's not trying to borrow and lend at the risk-free rate against big premium positions. So you sort of have to be in the space and playing for a decent size for those kinds of things to start making a difference. But I hope that helps explain it. So until Wednesday, when we have the next one of these, and we can go over it in greater detail, I guess we'll all wait to see how things continue to play out in Iran. Tomorrow, SpaceX options, they start trading. We'll probably have something to talk about there too on open interest on Wednesday. We'll see you then. Thanks for watching.